Hi. So, what happens when you want to sell the company but other shareholders disagree? Or when the founders want to sell their shares privately? Drag along and tag along rights solve these exit coordination problems, and in today's video, that's what we're going to be talking about. Hi, I'm Preksha from Campus Fund, and today we're covering drag and tag along rights in shareholder agreements and term sheets. This is a part of our larger series where we demystify term sheets and legal documents for your investment journey. So let's start. First is drag along rights, right? So what drag along rights do is that they allow major or lead investors, usually investors with significant stakes, to force founders and other smaller investors to join a sale of the company, right? So how it works is that, let's say if I'm an investor and I'm a majority shareholder and I decide to sell the company, I can basically drag along the remaining shareholders to complete the transaction with me, and other shareholders must sell on the same terms and price that we have decided, right? Now, thinking about why this exists, essentially it exists to prevent smaller shareholders from blocking strategic exits. Also, because when a buyer is buying out a company, they're not looking to buy a fragmented cap table, right? They're looking at 100% ownership, and drag along rights essentially ensure that. Apart from that, overall, I think it also ensures a smooth M&A transaction. So yeah, this was drag along right. Then we have a tag along right, which is basically a co-sale right. What that does is that it prevents minority shareholders, like founders or major holders, to sell their shares privately. So how this works is, let's say I'm a founder and I want to sell 10% of my shares to a third party. The investors of my company can basically tag along and sell the same proportion of their holdings on identical terms and pricing that I have set. Why it exists is basically to prevent founders from exiting early while investors are locked in, right? Apart from that, it also ensures that all shareholders have equal exit opportunities, and it also, in a great sense, protects the company and the people against insider trading as well, right? Yeah, so there are a few best practices when it comes to drag and tag along rights, which is, for drag along especially, it typically requires a super majority approval, which is around 66 to 75% approval of the board. Along with that, tag along rights, when you're talking about them, they almost always have a reasonable notice period, so you should keep that in mind. And third is that, ultimately both of these rights together and independently, they create alignment on exit timing for people, right? So what drag and tag along rights do is that they balance control and fairness. So while drag along enables clear exits, tag along prevents unequal treatment. So together they ensure that all stakeholders are aligned on the exit opportunities that the company offers. And yeah, that was it. This is a video on drag and tag along rights. If you have any other questions on the topic, you can obviously mention them in the comments and I would be happy to answer them. And if you want to learn more things about term sheets and legal documents, you can go watch our playlist and subscribe to our channel, because next week we'll be back with another video on another topic from your term sheets and legal documents. Thank you for watching.